Well, hello, everybody. Good afternoon. If you are in Europe, good morning. If you're just waking up in North America. My name is Gabrielle Joseph, and I'm joined by my colleague Alexandra Bazarewski in New York. And we're going to be talking to you today about private equity liquidity in 2021, and in particular, the results of our regular RedeConnect Index LP Sentiment Survey.
Thanks, Gabby. Hi, everyone. As Gabby mentioned, and for those of you that don't know me, I'm Alex Bazarewski, and I lead our coverage efforts across the Americas. The format of today's presentation is first to provide some context, looking back at the very strange past 14 months, and then to share some of what we're currently seeing, as well as what we think that means for the year ahead. We've entitled the first section, "Who Would Have Thought?" Because I'm pretty sure if we all rewound the clock 10 years, none of us would have predicted that Joe Exotic and Carol Baskin would be household names as a result of Netflix binges, that a paralegal from Suits would have caused a major schism within the royal family, or that double masking with a face shield and gloves and 3 extra bottles of Purell would be standard operating procedures for leaving the house. But yet, here we are. So even if we expect the unexpected, as is the mantra of this boardroom, it is really hard to anticipate exactly how events will unfold. Just over 1 year ago, on March 24th, Rede released its very first COVID pulse report to capture in real time the unfolding circumstances of the COVID pandemic. Well, it is easy to look back with 2020 vision at how events unfolded. It was extraordinarily hard to actually anticipate this in the moment. Approximately 1 year ago, we reported our findings that actually 64% of LPs were expecting to reduce their private equity deployment for the remainder of the year. Many had concerns about near-term capital calls, pre-COVID valuations, 0 revenue days, and the pace of forward deal-making activity. While many were quite pessimistic about investment-related activity, people are actually more hopeful about the opportunity to perhaps enjoy a summer working from home before returning to the office as normal in Q3, with actually 96% of respondents that we spoke to a year ago expecting to have their office be sort of totally up and running as normal by the end of Q3 2020. Now, I don't need to, of course, explain the irony of where we've ended up. With most of us still working from home, as this gentleman on the lower right-hand side of the page, and actually a remarkable rebound in the second half of this year. And you saw it across a number of paradigms. Certainly, deal activity, buyout volume, buyout exit volume really rebounded back. Fundraising volume, same story. And then actually, if you look at LPs' portfolios, the value of their private equity holdings actually increased over the year for 94% of LPs surveyed. Moreover, when you look at pacing and deployment for 2020, actually, despite sort of the prediction that many would be reducing, et cetera, what actually ended up happening was 82% of LPs ended up either maintaining or increasing their pacing for 2020. And actually, if you take a look, sort of slightly deeper into the data, what we found is that isn't just a reflection of, people are re-upping and sort of adding more to their existing GP relationships, but in fact, 68% of LPs surveyed actually increased their new relationships in 2020. So considering the circumstances, one might think it's easy to raise a private equity fund. And having the very good fortune to work at Rede with some of the top GPs globally, I can tell you it's never easy. We just try and make it look that way. But that said, last year was a year that favored large firms with deep experience. In fact, the top 10 firms accounted for 25% of capital raised, but only 1% of the firms in the market. Moreover, the large experienced players were more likely to be in and out of the market at an average of 6 months at target or above, while smaller, newer firms required more than double that amount of time in the market, and in some cases still did not reach their target. We are proud to say that at Rede, we continued to deliver for our clients through the pandemic. In fact, we've raised over 20 billion euros for 17 funds since COVID. And actually a third of that being sort of brand new money. And importantly, we would be remiss not to highlight that we've done this for both our existing and emerging fund clients. In fact, delivering sort of more final closes for those in the emerging category. We're arguably sort of navigating through the twists and turns of a final IC approval and commitment where, shall we, could be more eventful, shall we say. Anyway, with that sort of context in mind, I will pass the mic over to my colleague, Gabby, to share what we're currently seeing.
Thank you, Alex. So I'm here to tell you a little bit about the Rede Liquidity Index. One of my roles here at Rede is to look after the RLI, and I also manage our pipeline and origination due diligence team across our London and New York offices. Now, the RLI is is an index that provides a barometer on the health of the private equity fundraising industry. We started it in 2017, and one of the reasons why we created the RLI is that we know that there are many surveys, LP surveys, GP surveys, and lots of data around fundraising that comes out. But what we were looking for was something that can be tracked over time, and also something that is forward-looking, that doesn't just tell us what's happened in the last few months, but tells us what to expect over the coming 12 months. So we created the Rede Liquidity Index. You may notice, the eagle-eyed amongst you may notice that it bears a striking resemblance to a well-known forward-looking index called the Purchasing Managers Index, the PMI. It's a diffusion index, which means that it's a score out of 100. A score of 50 means that people expect on average that the liquidity within private equity fundraising will remain stable over the following 12 months. Anything above 50 means we expect an expansion, and anything below 50 means we're expecting a decrease in commitments to new private equity fundraisers over the next 12 months. Next slide, please, Alex. So for this edition of the RLI, we have a really good broad mixture of LPs from our RLI panel. So we had 139 respondents to our survey. It's a regular survey that goes out in the same format every time. So LPs typically respond again and again. It's important to note that the RLI only surveys institutional investors in private equity. So that includes people like pension funds, insurance companies, funds of funds, etc. And you can see that our panel is well distributed across geography, LP type, and size. Next slide, please. So the RLI score for the first half of 2021 is 66, and that's a 4-year high. It's the only time that we have reached such a high score since the first half of 2017, which was actually the first ever edition of the RLI, and maybe represented some excess enthusiasm from LPs at the time. A score of 66 means that on average, LPs are expecting to increase their commitments to private equity in the next 12 months. And I think it's instructive to take a look at how the RLIs developed over the last 12 months. So especially the 2020 data points before we look in more detail at the 2021 H1 score. So you can see there's a gray box around the first half of 2020 RLI score. And that's because our RLI survey remains open, typically for a period of about 6 to 8 weeks. And what happened was that in the first half of 2020, the RLI survey was open during the time that coronavirus was emerging as a serious threat, and then when the first lockdowns started. So what happened was at the beginning of February, when we opened the RLI, we saw record high scores, and then they essentially plummeted once the pandemic was declared and lockdown started. So we ended up with a composite score of 63, but that was kind of, we put it in pale gray because it was a very heterogeneous group of data. By the second half of 2020, we saw much more robust, homogeneous data. And we saw, unsurprisingly at the time, that the RLI score took a real tumble. And in fact, for the first time ever since we began the RLI, it dipped below 50, which meant that at the time, LPs expected to deploy less capital over the coming 12 months. Now, that has really turned around over the last 6 months. As we've seen, from Alex's slides that she presented just a few minutes ago, there was a real bounce back in the second half. And what you can see here is that only 8% of LPs over the last few weeks answering our survey felt that they can be, felt that they will reduce their commitments to private equity in the next 12 months. Whereas that figure 6 months ago was 19%. And in fact, we are seeing very strong sentiment across the board. So that figure of 40% of LPs expecting to increase their commitments is a record high for us. So it's overall a strong picture for deployment in the next 12 months. But the question is, what will, what does this look like when we break down the RLI into some of its constituent parts? So delving deeper into the world of the RLI, we can see that there's particularly strong bullishness about private equity deployment amongst European-based investors, with North America not far behind. And beyond that, across the globe, we're seeing that all investors are seeking to increase allocations to both North America and European-based funds. So just under a quarter of LPs are planning to increase their allocations to both of those geographies over the next year. What about LP type? You can see there's particularly strong results amongst the consultants and the endowments and foundations. That's actually really interesting. And we note a particular pattern here, which is that the endowments and foundations in particular, we view them as a real bellwether of the industry. They tend to be some of the most sophisticated investors within our asset class. and they often have a real handle on the outlook for the next few months, and where they lead, other LPs tend to follow. So when we see particular bullishness amongst the endowments and foundations, we typically will expect that it will be a highly liquid environment for fundraising in coming months. Now, we do have a number of sub-indicators within the RLI. So we ask investors not just whether they're planning to invest more, the same or less in private equity funds in general, but we also ask specifically about secondaries and co-investments. And you can see here the quite different trajectories that both of these sub-indicators have taken over time. Secondaries has been historically, we've had a number of LPs saying that they were planning to reduce their allocations. And so overall, they were actually down there below 50 for quite some time. And we typically think of secondaries as somewhat counter-cyclical, where as primary fundraising expands, sometimes we expect secondaries to contract with pricing increasing to higher levels and less enthusiasm to find bargains amongst secondary LP sales. We've seen that changing, and I'm sure some of you listened to Magnus's fireside chat with Nick Morandi about the state of the secondaries industry. We've seen that that's changed over the last year or so with the growing importance of GP-led transactions, which has led secondaries to be of real interest across the cycle. And so despite the fact that that we're seeing strong liquidity on the primary side, we're happy to see strong expectations amongst LPs for their deployment to secondaries as well in the coming months. Co-investment, on the other hand, has been riding really high for several years now. Now, unsurprisingly, we did see a pretty big dip during the initial COVID crisis as a number of co-invest processes were put on hold, but we've seen that that's really picked up. And so we're really seeing very high levels of enthusiasm to continue co-investing over the next few months amongst LPs. Now, when we look at liquidity overall and expectations for liquidity in the future, there are really two key factors that drive this. The first is the strength of the top-down allocations amongst large institutions to the private markets, to private equity. And the second is the velocity of distributions of cash coming back to LPs from their existing private equity portfolios, which then frees them up to make new commitments. Together, those two factors interact to create the overall liquidity. But what's interesting is that you can, in fact, imagine a world, which we often see, where there's a steady state in private equity allocations, but commitments to private equity are increasing because the cadence of distributions has ticked up, providing more capital for LPs to put to work with new funds. So if we look at those two factors, we can understand the liquidity picture for 2021, 2022. When we start with distributions, with the distribution picture, we can see that there's been some dramatic changes in LP expectations around distributions over the last 12 months. So we're currently at a record high. We've never seen figures like this for LP expectations of distributions. And it's no surprise because, as you saw previously with Alex, there's been some phenomenal exit activity over recent years, over recent months. And fully 90% of LPs are expecting either the same or more money to be coming back to them as distributions in coming months. Now, we're actually seeing a number of new exit opportunities materializing, opening up for GPs that can help boost that distribution flow back to LPs even more. So one example that we picked up here is the rise of SPACs. I'm not I'm not an expert in SPACs, but I think it would be remiss of us not to mention that, you know, over the last couple of years, there's been a huge expansion in the capital that's been raised for SPACs. There have been notable fundraisers amongst highly respected managers who have now raised significant SPACs. And what we're now seeing, as you can see on the right-hand side of this slide, is that there are, you know, there is really a wall of SPAC capital that is out seeking investment opportunities. And so those SPACs will represent a really interesting exit opportunity for many of the private equity managers who have joined us here today on this webinar. On the allocation side, we see this holding firm. So despite the challenges of the last year, the public markets have managed to hold up. I mean, not even just hold up, they've you know, seen really strong performance. And so we've been able to avoid that horrible denominator effect that some of us who are old enough remember from the global financial crisis. And so together, these elements of exit velocity and allocations to private equity, they're driving the ability of LPs to really dial up their commitments to private equity funds. And you can see here on the right-hand side, the famous volume dial from the Spinal Tap movie that goes up to 11. It's a very important distinction from a normal volume gauge. And so overall, we're happy to say that in conclusion, the future for private equity is liquid, and we're looking forward to an exciting few months ahead.
Thanks, Gabby. So while it feels like it should be a share Horowitz and Clueless shopping spree moment for LPs, I can assure you it doesn't actually feel that way to LPs who are constantly fielding can't miss opportunities via email, phone calls, increasingly probably text, WhatsApp, app chats, etc. And in fact, if you look at the data, LPs are really spoiled for choice. If you look at this chart here, you'll see that since 2012, the number of funds in market has grown at a 17% CAGR, which just underscores the robust sort of opportunity set for LPs. And you know, and I think the other point to make here is that, you know, budgets can get spent quite quickly here. And, you know, it's been a trend we've seen for quite some time, but, you know, certainly this year, you know, has been no exception, is, you know, a lot of the annual budget being either spent or earmarked in the early months of the year. Now, digging a little bit deeper into, you know, some of the dynamics that are causing this increased sort of choice, I think there are, you know, two really important factors that, you know, to bear in mind. One is that GPs are returning to market with their successor funds at an accelerated pace. You'll see a sample of funds here across the sort of middle market and upper middle market, North American and European buyout firms, where if we looked at the interval between the most recent vintage and the prior vintage, it's actually the interval between fundraisers has gone down by a full year. And I'm sure, we can all think of anecdotal evidence to support situations that have been probably even quicker than just over 3 years. The other dynamic at play is that GPs and successful GPs are often expanding their fund families and really relying on the support of their existing LPs to back them in those efforts. So from an LP perspective, there's some real positives for this, these two dynamics, as LPs want that strong bond with their GPs. But we would be remiss not to mention, probably some questions about sort of share of wallet, what is sort of the appropriate level when you look at a GP relationship across vintages, across sort of funds within the family. Now looking, I guess, beyond existing relationships, where are LPs sort of focusing their attention for new commitments and new relationships? You'll see here from our survey data that, perhaps unsurprisingly, the strategies that are seeing the most interest are those sort of in the growth equity or the lower or middle market buyout space, where strong recent vintage performance paints a compelling picture about the forward opportunity set. There is also quite a healthy appetite for secularly growing sectors. Not, probably too surprising to anyone to see sort of healthcare and technology at the top of this list in terms of the sectors where LPs expect to increase their allocations. This is something that's also certainly been mirrored in the public markets. But, there are a few other things I'd like to call attention to. One being that we're increasingly seeing interest in impact funds. This is an area that Reed has been constructive on for a very long time. My colleague Christina addressed it yesterday in our predictions for the next 10 years as a sector that we are seeing a lot of interest and expect to see continued interest and demand for that sector. I think one other point I'd like to make is that while the data here is somewhat muted, anecdotally we're certainly picking up interest in exploring sort of the maybe less white hot sectors. LPs want to make sure that they have enough exposure to some complementary strategies such as industrials, et cetera, so that they really are sort of building a balanced portfolio. Finally, just a note on first-time funds. At our webinar that we held about 1 year ago, we made the point that historically, some very strong companies and private equity firms have risen in spite of, or perhaps because of, very challenging circumstances. Recognizing the unease at the time of virtual diligence, underwriting, this is actually sort of quite a bold prediction that we made about the year ahead. But it appears as though it has come true. In fact, 49% of LPs that we surveyed indicated that they've made an investment to a first-time fund since COVID. And as you'll see sort of on the top right-hand side here, there's been some quite extraordinary groups that have sort of emerged during this period. The overall number, of course, is lower, and I think that just reflects the very high standards of the market today to fund and back a first-time fund.
Okay, so this week here in the UK, we've seen a partial reopening after some long winter months of lockdown. So I'm happy to report that I'm going to be hanging up my home hairdressing scissors for good. And I'm no longer attempting to wrangle 4 young children off of YouTube and onto Zoom school every day. I think everybody's looking forward to the next few months as the vaccination program ramps up, but it's clear there will need to be a period of readjustment, as you can see from these people in their in-person meeting. I can assure you that as a mark of respect for RedeConnect today, I am fully clothed underneath this webcam's line of sight. In our LP survey, we asked investors to give their best estimates for the timetable to returning to more usual working practices. And obviously, none of us can know exactly what will happen, but we do believe that there's something to be said for the wisdom of crowds here, who understand their own organizations and their thresholds of risk, appetite. It's clear that most LPs believe that they will be back in the office, they will be meeting GPs, maybe they'll even be traveling again by the end of this year. You can see on this slide, we've highlighted where on the timeline we're hitting 75% of LPs expecting to be back to normal in those respects. And it is mostly around the Q3, Q4 mark. But not everything will go back to normal, and LPs are overwhelmingly telling us that they are looking forward to changing their working practices in the long term and not going back to the bad old days in every respect. So in particular, the GP-LP interaction process will need to change. So we're expecting to see first meetings going online, then people may be joining group video content. And then as that relationship is being built, that's when the in-person meetings and the travel will start to kick in. Incidentally, due diligence sessions, so on-site due diligence sessions in the very final stages of LPs looking to make a commitment to a fund, we found that doing those via video have proven to be very efficient for a lot of people. And that was against quite a lot of people's expectations. And it allows a much broader group of people to attend those diligence sessions, because previously you would have to choose who would travel for, maybe 1-2 days to visit and spend all day on site. So we're expecting that in the future, we'll probably see due diligence sessions split up, where there'll be a site visit, which will be important, an important thing to happen. But then some of the more nitty-gritty detail will be dealt with on video, where you can also have a broader spectrum of people from the LP attending. And then for existing relationships, we're also seeing LPs expect to reduce their face-to-face contact. So we're expecting them to spend more time keeping on top of developments with streamed content, so things like quarterly webinars, and with written updates, and a bit less time spent in in-person sort of annual updates with their existing portfolio. So the Rede view on the new normal can kind of be summed up as follows. So working from home can be surprisingly efficient, and we've seen how much can be done remotely. For many of us, the increased flexibility for work to fit in around family life has been quite valuable. So don't throw out those sweatpants yet. We're expecting that there will be an ongoing reduction in travel for meetings, which for many people will improve their quality of life quite significantly, no longer sort of living on an aeroplane and out of business hotels. But there's no substitute for in-person relationship building. So it will be more targeted rather than just a reduction across the board. We're expecting to see video content and group streamed events really becoming much more mainstream amongst the private equity world. We know that on the public side, this is common practice. We know that overall people have put, real effort into their video content offerings, and we think that this is something that will need to be a real focus for GPs over the next year. In-person AGMs are important. So I think our first live streamed AGM that we advised on was in late March. And since then, we've become kind of the masters of assisting our GPs with their live streamed AGMs, practicing with them, spending time on their backgrounds, on their TV presenting skills. We do think that they are going to go back to in-person, but we're going to have hybrid offerings because there are more and more LPs that just will not be able to travel for every AGM. So we will need to have a viable streaming option for every single AGM that a GP puts on. And then finally, we believe that the private equity conference industry is in trouble. And, frankly, that's evidenced by the fact that we're all sitting here at RedeConnect today. And it's something that nobody's spent any money on. Nobody has had to travel across the world for, and nobody's had to be crushed, against a radiator in an unpleasant tea room after fighting their way through for a biscuit. So I think that we are going to see a recalibration of the conference cycle, with maybe one or two conferences emerging as a must-have, and some others falling by the wayside. But overall, 21 and 22, in conclusion, they should be a really exciting time for private equity, and plenty of opportunity for both LPs and GPs to benefit. And as the cartoon shows, as fundraisers, we hope that we'll be able to matchmake many more funds and investors well into next year. So thank you so much to all of you for joining us today for this webinar.
Thanks, everybody.